David, mortgage REITs, Annaly Capital Management is at the top of the heap, largest, most successful. You are going to take a bull case on this, and I'm going to tell you how you're wrong with my bear case. Why don't you get started?
Yeah, well, the market's been on your side recently. The stock's trading down a little bit. But I'm still bullish on the company, maybe call me a 7 on the bull scale. When I look at the dividend yield, and that's the main thing that people look at when they think about Annaly, the dividend is around 12% right now, the dividend yield.
Right.
When we look at the yield on junk bonds right now, it's around 5.2%.
You're really going to take a bull case by arguing how the dividend yield compares to junk bonds. Is that really what you're telling me?
That's part of my thesis there.
Continue.
So when we just think about the risk spectrum, the difference there between junk bonds and this, I know the dividend yield is not set in stone. That can change. The dividend can be cut. But this is, when we look at the management team at Annaly, this is the most conservative management team of the big mortgage REITs there. They understand this is a challenging environment. They're not out there being super aggressive. Wellington Danahan's come out and she said, we're going to be nimble. We're going to try to dance around this. So
yeah, well, I think that's all well and good. I think it's easy to say that you want to be nimble, but when we look at the interest rate environment right now, this is not the interest rate environment to be in a fund like this, in a company like this. The most advantageous environment for these kind of companies is when you're in a high going to low interest rate environment, because the cost of funds moves so much more quickly than the return on funds that are on the balance sheet. So basically what happens is that as interest rates fall, the cost of funding drops while the returns on assets do not drop as fast. So you get this expanding spread. Now, on the opposite end of the spectrum, from low to high, you get the opposite happening as the cost of funds rises, as it's much more difficult, much more time consuming to increase the return on funds on the balance sheet. So right now, we're in that low interest rate environment. It's still unclear exactly when that's going to change, but it will change and it will come up. And I question how nimble they can be. No doubt in my mind that Annaly will be one of the best managing that. Mm-hmm. But you don't want to buy the best house on the worst block. You want to buy the fixer-upper on the best block. For me, maybe I keep an eye on Annaly, but right now in this environment, I'd rather just be on the sidelines.
Well, everything that you just said right there, I think it supports my case, because all that pessimism has made its way into the stock price. People are getting out of these mortgage REITs. There's all this speculation in terms of what's the interest rate environment going to do. I think that's working its way into the stock price. And if we take a long term, we will probably get to a steeper yield curve in the future. And maybe that's already priced in today. So that's my stance.
I think that's very optimistic if you think that's fully priced in. I think that there are these generalized concerns about interest rates, but I think that the extent to which interest rates will hit the bottom line and cause a reaction in the stock. And so then, you see these big dividend yields, but those can be offset by capital losses. Now, for a really long-term investor, maybe that's not such a big deal, but how many investors are going to get into this because they see a big dividend yield, and then the interest rate environment is going to change, the dividend will be cut, the stock will fall, and then they'll get scared out of it. And so they've gotten these big dividends for a couple of years, but then they're sitting on a big capital loss when they're selling out of fear.
We're not going to agree.
All right, let's move on.